Hi, Ryan William here from Smartest Data with what's going on in the US economy and the stock market with the week starting the 23rd of January. Okay, let's start off with economic data. This week, US GDP for the fourth quarter is expected to be announced and it's expected to be a rise of around about 2.7%, down from the 3.2% in Q3. Durable goods orders in the US is expected to be around about 2.2% increase after falling 2.1% in November, and that was the sharpest drop since April 2020. Onto initial jobless claims, they're expected to rise around 202,000 in January, up from 190,000 in December, indicating unemployment may be increasing in the US. Now, this is a volatile data series. If the result is less than 190,000, it will give further credence to the fact that the US labour market could be quite tight despite all the actions by the Federal Reserve. Okay, later in the week, the University of Michigan Consumer Sentiment Index will be released, and that's expected to rise to 64.6 in January, up from 59.7 in December, and that's the highest level since April. Also, stocks were fueled on Friday with some dovish comments by one of the Fed's governors. In a statement, he said he currently favours a 25 basis point increase in rates at the next FOMC meeting. Okay, with that done, economics, let's go to stocks. Okay, so for the week, the S&P 500 index was slightly down. The NASDAQ index closed up 1.3%, while the Dow Jones Industrial closed down 3.5%. Keep in mind, this was largely dragged down by Goldman Sachs. Quickly on Goldman Sachs results, the results posted on Tuesday were worse than expected due to higher than expected expenses combined with a slump in deal making. Goldman Sachs is probably in some businesses where they're not a leader, in particular in the platform solutions units. Look, if Goldman Sachs really wants to pursue this sort of business, they're better off going out and buying something to build it. Deal making was also down, but I believe Goldman Sachs will bounce back. They will make money. By the way, it was a blowout quarter for Morgan Stanley. Okay, so let's look at some of the key upgrades, which is listed on Atom Finance. Okay, so Atom Finance is one of the databases which I use, and they have upgrades and downgrades for the research cores. So you can see here on the upgrade side is AMD, Advanced Micro Devices, Qualcomm, Seagate, and Shopify. On the downgrade side, Applied Materials, Ingredion, KLA Corporation, and Range Resources. It'll be a busy week for earnings with Johnson & Johnson, Verizon, Intel, Dell, Comcast all announcing, as you can see on the ticker below. I believe earnings will be better than expected. Companies will beat. Earnings growth ex-tech will be around about 5%. Companies have driven expectations out, so 5% will be quite positive. If you include tech, earnings will be down around about 2%. Okay, so let's take a quick look at sector strength by moving averages 20-day to 50-day by bar chart. So moving on to the sector heat map from bar chart, and this is the percentage of large cap stocks above their 20-day or 50-day moving average. Okay, so we can see from the top, the S&P 500, the average is 68% of the companies. Sectors which are overperforming or in line: consumer discretionary 82%, energy 91%, financials in line at 67%, information technology at 84%, materials at 93%, and real estate at 97%. Then communication services at 84%. The two laggards are utilities at 13% and consumer staples at 21%. So on Friday, there was a rally in the stock markets as one of the Fed governors spoke up, but also the mega cap tech stocks rallied sharply. Netflix jumped more than 8%, Nvidia rallied 6%, also Alphabet climbed more than 5%, and Amazon was up around about 3%. The focus on tech stocks is the level of staff cuts, which is across the industries around about 60,000 people. This is the headline, but it's not the story. Tech stocks need revenue growth, growing margins to be profitable. Okay, there's a lot of focus on the bottom line earning for the main tech stocks at this point in time, and it's going to be a disaster. Let's think of this. Amazon is going to be down around about 87%. Netflix down 66% despite the blowout quarter. Meta down 40%, Alphabet down 23%, Microsoft down 7%, and Apple down 7%. But think of this. Revenue year on year is only going to be slightly down or even up for some stocks. So let's go through the list. Amazon up 1.5%, Netflix up 1.8%, Meta down 6.6%, Alphabet up 1.7%, Microsoft up 2.4%, and Apple down 1.5%. What gives? What's the difference? So here we are inside of Atom Finance with the screening tool. And so what we decided to do was look at technology and technology equipment companies over 100 billion in market cap, which are going to have a sales growth of over 5% for FY1 and 5% for FY2. So if we looked at the large cap stocks here, we see Pinduoduo is at the top of the list with MasterCard, Microsoft, Adobe and Visa. They're the top 5 stocks. We also went down to the next level, so between 100 billion in market cap and 50 billion in market cap, and the top stocks there were Mercado Libre, ServiceNow, Shopify, Uber Technologies and Airbnb. So one of the key things going forward, the restructuring story is there, that's the headline story, but one of the other key stories there is how they can grow their top line. The bottom line in the end of the day with these companies will work itself out. Okay, so let's take a look at the portfolios, the top 10 stock picks. So I switched from Caterpillar into Apple. I'm also considering Goldman Sachs. There's another new thing which I'm going to introduce today, and that is the final trades from CNBC, when the guests on their various panels give their trades. Okay, so let's go over the portfolios and take a look. Okay, so here we are in the portfolio, the top 10 stock picks from the beginning of 2023. So as you can see, the portfolio has done quite well, up 8.6%. So let's take a look at the by earnings rating. What are the strong buys? So I've got Wells Fargo, Amazon, Google, Nvidia, Qualcomm, and the buys are Bank of America, Verizon, and Apple, with Exxon being on a neutral. Okay, so where's the performance come from? Okay, so all up, there's an estimated 35% upside from here. What's done well so far this year is Nvidia up over 29%, Qualcomm up over 22%, Amazon 14%, Google over 11%, Apple 4%, Wells Fargo 8%, Exxon 2%. The lag has been Bank of America, Verizon, and Raytheon is down 4.4%. Okay, so this is a new portfolio idea which I'd like to explain to you. So it's the final trades for the halftime report on CNBC where the panelists give their stock picks. So I put this in yesterday. Okay, yesterday it earned 70 basis points. So this is up to the end of last week, the 20th of January. I'm going to run this for around about 3 months or so. Okay, so let's take a look at the allocation. Okay, so we can sort of see here, there's some of the stocks are up there at 15% allocation. They're the larger stocks. Then other ones such as Goldman Sachs is sitting around about 10%, and then the other stocks around 5%. So it is a stock pickers portfolio. It is not a portfolio that is looking to track an index or beat an index. So it's the way you'd manage shares, which is buying and selling individual shares. So you can see here, cash is a minimal portion, stocks around about 90%, and ETFs around about 10%. And the two ETFs as the materials ETFs and large cap China as far as upside potential. So on the analyst pricing, the upside potential is around about 10% from here. Okay, in closing, the economic data suggests that a recession is more unlikely. Inflation is trending down, still not under control. The Fed's next move would likely be 25 basis points. Some commentators are calling for 50 basis points. Short term, this would be negative for stocks, but I don't think so. But as I've said, this could be an earnings recession. As we can see by the tech numbers, it's a manufactured one of that. Company are doing provisions, restructuring during a period of slower economic growth and come out much stronger. The equity markets are currently doing this. They're looking way beyond a possible recession, which is exactly what we want to see. Invest with a focus on the end of 2024. Things looking good for those that analyze the stock markets. There are videos coming out every day, so like, subscribe and ring the bell, and looking forward to seeing you in the next video.